Okay, this is a video about corporate modeling. And specifically, this is a video about what not to do. It is about the third or fourth or fifth time I've tried to start this video, and every time I have started, I have ended up swearing loudly. Okay? I'm gonna try to make this video, and God, I'm not going to stop it this time. So instead of making a video that is currently on my website here, I make kind of a one way to learn is going through some completed models and try to hopefully these are reasonably structured models and try to understand how they're made. Another way is to click on this corporate modeling page and go to this lesson set 1, and supposedly got kind of a little bit of a way to take a model and make it from A to Z, and you just you would begin it with the assumptions, and then it goes line by line. How boring is that? Now, maybe that's why not many people have really looked at that. Now, another way to really learn this, and perhaps this is the most interesting thing, is to take an actual model and see, well, I'm going to see what was wrong with it. Now, this model was given to me. It was given to me a couple of years ago, and the person who gave it to me said, look, he was saying, you're making these simple models, but look at this model I have. I mean, this is just a masterpiece. This should be in some kind of museum. And this model, how many pages does it have? Just a minute, I'm going to put the table of contents. I'm in the generic macros, and I'm just clicking this thing called Create Table of Contents from Sheet. Okay, that was a hidden sheet. That's why I switched off. If you run this table of contents, cannot have any hidden sheets. In fact, I should put a little adjustment to that generic macros to take away the hidden sheets. Well, enough of that. Now, so there are 40 different sheets, including the table of contents we just made. And so here's what I'm doing. I think a real way to learn is what you can do in your life. You make mistakes. I make so many mistakes. It's in every aspect of my life. It's I don't know. I wish I would learn from my mistakes. I seem to have a hard time doing that. Now, when I teach case studies in a class, I said, how boring would a case study be if it's a case study about a fancy business strategy that's all good? Screw that. How case studies about failures are so much more interesting, and what mistakes did people make, and how can we find patterns of valuation and risk errors? That's the way to do it. Now, I'm doing the same kind of approach with a model, and I think that might be a better way to learn corporate modeling. Now, I'm going to make 3 videos about this. The first is just to take a quick look at the model and see what we can find. Now, one of the good things about this model is that the balance sheet was there and invested capital was there, so they computed return on invested capital. Did I say that this 40 sheets, that's not a present, that's a ridiculous, oh my gosh. So what you do is when you get such an enormous model, what's the first kind of thing to do to check if this is a reasonable model? We'll try to do the same thing with project finance models. And I want to find the ROIC and look at the ROIC, especially in the terminal value. And now we'll look for some just bad kind of Excel practice. We'll find some financials. I'm going to compute some. If I had to take this model and look at it very quickly, I'd want to get some depreciation to net assets, to look at the depreciation rate. What did they say about the ROIC, capex to depreciation? How does the projected and actual data look? And I'm going to put capex at, to EBITDA. And what does EBITDA look like? What's the margin? Some of those. Now, in later, we'll look at the DCF, a whole analysis really on the DCF. Okay, and then depreciation, because this case study is almost a case study in what goes wrong when you make a seemingly advanced depreciation calculation that really messes you up. Okay, now, so let's begin. Now this is a HT Media company, and they have a nice little summary page, I suppose, but it only has 3 years of a forecast, and the first thing you might look at is what happens to the EBITDA. So we have some EBITDA that perhaps in the first year was supposed to go down, but then it was a rebound, and it's going to rebound really, really well by the time this occurs. And of course, everything in a corporate model is the terminal year. Now they also have some ratios, and they have the return on average capital employed. How fancy is that? Well, it must be really good. And then I'm pressing F11, and that's our little graph. But notice how it goes up in that last year. Now, if that was a terminal year, you'd immediately say this whole thing is questionable. Huh? But I'm not going to say rubbish. And then they have some revenue lines, and I think I'm so tempted to just begin making a model where a graph where we put the actual and expected. So we look at this, but this has got all the detailed, and then they have detail of all this stuff. Oh my gosh. And then somewhere here, salient, they have consolidated financial statistics, and from going through this before, it took me a little while actually, but I realized that kind of these are the key sheets. Now I'm going to make these different colors so we can kind of track where things come from. All right, and then they have the cash flow, which really, I think the cash flow should be kind of before the balance sheet. The balance sheet is kind of at the end. And then down here, they have a depreciation that we're going to spend a whole lot of time on. And they have a consolidated discounted cash flow. So this is still a kind of just, how about a purple sheet for that? This is an introduction. There's so many things to fix on this DCF model. That just has to be a separate video. Now it turns out that it's kind of hard to see, but the terminal value in the DCF model was in fact 2020, and they had this. I love this. We have a range in value from 111 per share, that's the low, up to 183 per share, that's the high. Now, in a minute, we're going to see what actually happened to the company. Okay. Now let's look at just a couple of basic things before we do that. If we look at the consolidated financial statistics first, here's some inputs, and then the inputs change to a formula. Now that's how corporate models are supposed to be with some actual followed by some forecast, and then these beautiful colors that I couldn't even see how they got from. These are all inputs, and then we have some sums, and then some calculations. That's kind of nice. Some calculations of the growth rates, and then some newsprint. This should have units on it. Okay, unfortunately, these, when the way I did the coloring, these wouldn't show up as an input color, and then some of these ratios, and then I got some EBITDA and other things. Of course, if you're, first of all, there's nothing wrong. The way to really set this up is to put all the historic financial data in one place, and then start combining it, and put a lesson number 1 is the historic switch. Okay, and lesson number 2 is show you where things come from. Make the model transparent. Now this I have to put over here. So I'm going to do a little bit of this. So the last historic data is 2011. This should have really been kind of in a assumptions page somewhere, and we just go to this one and put less than or equal to this with F4. Okay, so lesson number 1, it seems that in almost, oh my gosh, I didn't even see this. Never do this. Oh my gosh, common size. So they put this all next to it. Oh no, another very bad thing to do. So let's move this into a logical place. Oh, no, I'm going to pause and just move that below. Okay, so that was a little bit of a pain, but I put these all on the same page. And then to kind of see what's going on. Now, the last thing you want to do is something I used to do, which is make way too many graphs. Let's try to make one graph that compares the history and the forecast. But let's emphasize all over the place this. Oh, here, look at this. Look at this. Look at this. This is crime of crime of crime. We have a variable, and we put the formula together with the fixed number. You cannot do that. Oh no! You have to. What you would do is take. Let's just do this one single calculation to show you how you should do this. Somewhere you'd have a assumption, and we'll have to summarize this somewhere, but I'll just show you how to do this. Okay, so we have some historic data now. Let's just take all of this historic data. Let's get the coloring right. I seem to be a little bit obsessed with the coloring. These are all just inputs. Okay, so I have generic macros open. Control-Alt-C. Oops, I have to initialize the macros. That means I have to press a button. Okay, Control-Alt-C. And how about we'll color it some kind of basic color, and I am not going to color column A because and then we can kind of see what's an input and what's a formula. Now with this job revenues, we don't know what to do because we have inputs and revenues together. So I'm going to copy this up here just for a minute, and we should put our historic growth here. So this is 0.15 and 0.1, shift control 1, and 0.1, and I'm looking at what assumption they made, 0.1, and then 0.05. Okay, and the way you should set up all of the assumptions is, look, this is the historic number, okay, and we can take this divided by that. So in the history we had a reduction of 21%. I apparently have the formulas off, and where is our job revenue? Okay, that's our history compared to our forecast. All right, and then when we make our analysis, if we're looking at kind of our, I'll just use this one. So we'll put job revenue. We would really put job revenue history here. And then we would have some assumptions. Job revenue assumptions. Okay, and we lay out that clearly, and then we have history and forecast. And you would say, okay, if it's the historic switch, then we just take the history. Otherwise, if it's not the historic switch, go backwards 1 and multiply that by 1 plus the growth rate that you assumed. So we can show what the growth rate is, and we can't use the sum here, of course, anymore. So I'll fix that offline in a minute. All right? Okay. No, I'm just going to, okay, minus this, that's, don't do this, please. This is not good practice. Minus this. Okay, because oops. All right. That's enough. Okay. And shift control E, have a nice little thing. So, okay, enough of that. So we have our history and our forecast together. And then just I'm going to press Shift F11 and make a crude graph. Shift F11, and I want to take all of the data, and I've done this before, but so in column D, I guess that's where we began the thing. So I'm going to put our year here. Okay. And then we're going to use the index function to show what's the to graph all of the history and the forecast together. And what you really want to do is just the way I showed this, Shift Control R would copy it. Okay, and now let's just make a little index. The way we do this is you always start with a row number, and just put a little number here, and then on the row number we'll pick a row number, okay, and you put equal index. I haven't done this for maybe a year. Yeah, I've done this recently probably. And then we put a comma, and then you just go back to the thing, and that's our row number. And then once you have that, F4 the thing, okay, and let's put row number 10 or something, okay, and then we have radio revenues, okay, and we can get all the revenues. Now the very next thing perhaps to do is go to the developer tab, insert a little a little spinner box right next to that and just say, okay, well, let's make that go from, let's start with about row 4 or something, I don't even know, to maybe row 300, I can't remember it. And then, you need to use the windscreen wiper approach to click on this line, so you have to absolutely make sure it has the sheet name in there. Okay, and then we can get all of our assumptions in the whole page. There are a lot of blanks. That blank is a big issue for me, but for now, at least we have something. Okay, and then we say, well, if it's the history, then we'll take this one, and you just put a little if statement, and then you call it history, and then you make a forecast, and we put if it's not the history, then we go up to this one. So, oops, and I need a little thing around the knot, okay? And then we can make our graph. And on the graph, I'm going to put our lines here. Okay, and I'll just have alternate F1 instead of F11. Then we have our forecast and our history. And for the chart title, simply put so the taxes were going up, and then we put our thing in, and we can kind of see what happened to everything. Now you can also then very easily just go to the developer tab and put a drop down or combo box or whatever you want to call this thing, and this time do the same thing. Just click on column A, I suppose, and then go back to our windscreen wiper and put the number there, okay? And oops, and I'm going to try to find the return on the return on invested capital was in another one. Here's the, oops, I thought I print advertising. Okay, it's working. All right, that's how you want a history and a forecast. That's a really big deal in all of this. Now, I'm about to finish this video, okay? Okay, it's just got a few things clearly wrong, but the biggest thing that's wrong is not all of this Excel stuff. If you go to the balance sheet, at the very end of the balance sheet, it takes so long, he finally has this stuff. Oh, thank you for putting this here. And he does this little thing. And now, here, can I just say a couple of things? If you're going to make a formula like this, that's a complicated formula, show the components. Show what's driving it. He divides he's got invested capital on the bottom, and this adjusted invested capital, this formula is so long, I don't even know what it is, okay? But let's look at the return on invested capital. Now remember we said 2020, that was the forecast year. And the return on invested capital was going up like this. Okay, aha. Now if you read this book that is such a famous book, and look at all my comments in here. This is valuing, measuring. This is I call this the McKinsey book. I went through, and in each chapter I said why I have a comment on. It's, of course, a very good book. But it's also not, when you go to advanced things, you can comment, you can kind of disagree. At least I disagree with almost everything they do. That's bad. Shouldn't have really said that, because that's like You will never believe anything I say, but I'll discuss that a little bit later. We would want to show the history and the forecast. This is the danger. You think, oh, this company is going to create shareholder value. Well, of course, something's wrong. Now, to see what's wrong with this, let's compute some ratios. And one of the first ratios I suggested to put, let's take our depreciation expense. Let's find the depreciation expense. I think that the depreciation expense is up here, D&A expense, okay? And I'm going to switch the sign on this. Apparently, I'm supposed to multiply this by minus 0.1. So the depreciation expense is going up. And let's find the capital expenditures. And let's put this in. So the capital expenditure, this is, he's got CapEx, but let's look at just in the cash flow model. And in the capital expenditures here, okay, we have it. And then there's some purchase and sale of investments as well. So they were making big purchase of investments to get their EBITDA up, but we didn't have that in the future. I'm just going to use the CapEx just for now at least. And here's the problem. Well, okay, depreciation. Depreciation is above the CapEx. So let's put depreciation to CapEx. Okay, and it was below here. All right, and then you say Shift Control 1, Shift Control R, and or maybe Shift Control P, and the depreciation to CapEx in the history was about here 44. Then it suddenly skyrocketed, and you say it keeps going up like this, 160, 112. Now, then we put let's put EBITDA. And we can find that, I suppose, in the profit model. Okay, so once you hopefully do that, Shift Control 1, Shift Control R, and we can put CapEx to EBITDA. And in the historic numbers, in that we have 51%, and then it goes, and then remember, this doesn't include all those acquisitions either, and then it goes all the way down to 18%. Something is not looking so good. Maybe that's why the ROIC is going up so much. Then, and if these CapEx in the last years are completely inconsistent, so if we overstate the depreciation, perhaps we overstate the CapEx. This is the worry thing. Now, let's just compute a couple of others. I suggested also perhaps checking. We've checked ROIC a little bit, and we have some issues with that. We've checked. How about we'll put working capital? And hopefully he has that. So some of the thing was actually pretty good. He put the cash, current assets. He put current assets. This is really current assets other than cash. He called gross block. Interesting. I don't even know what that is. And then we put the working capital to EBITDA. And we say, okay, and that's just kind of doing the same thing, checking whether our working capital assumption is reasonable. And suddenly we have 200, 277 here, and it's going down. Why is that? Those kind of things make a pretty big difference in the model. The other thing to kind of check to make sure, and so we've, just by looking at this, I hope you understand that this is invalidating the model. And this comes from probably the CapEx assumption, maybe the EBITDA growth. Let's put EBITDA growth. Now, if this is a media company, they're getting killed by the internet probably. So how could we assume a lot of EBITDA growth? And what happens is we kind of had a down year and then it starts going up a lot. Okay, not that much. So, okay, maybe, this growth market, blah, blah, blah. And then we can put our interest expense and find that. And I think that's going to be in our profit model. And where is that? Here we go. I'm going to make that a negative, and then we can take that and compare that to the average debt, rather, and then we can get the because if you're comparing a balance sheet item, you better kind of take the average, and down here, up here, we have this. Uh-oh. Okay. I hope I did that all right. No. Well, in the first year it wasn't, but I'll just take that and divide it. All right. This some kind of fancy formatting. Oh, no. Okay. Excuse me. Okay, I can't get the formatting right. This is probably reasonable. Shift Control P, 15%, 20%. It went to 18%, and I think I messed something up with the average. I'm just going to take the end of the year. I'm really sorry about that. Okay, those are the kind of things you should do. Now, just to finish this off, if you go, now let's see what actually happened. If you go to the consolidated DCF, remember this was his valuation, and this was the low valuation, and this was the high valuation. If you go to Google Finance, okay, and you try to find HT Media. Look, they have it. And you can get some historic stock prices. But there's no download option here. If you would look at a different company, let's look at Renault and look at their historic prices. They don't have it either. But then let's look at Saudi Cement. How about Saudi Electricity Company? And then we look at their historic prices, and they have it. And then let's look at the FTSE. And then let's go to the historical prices. They should say historic, really. They don't have it. Let's look at the TASI. This is in Saudi. And look at those historic prices, and they have it. Now, I was going to make a whole new video. So when you have, because I spent all day on this. I spent all day. When you have something like this in Google Finance, remember Yahoo got replaced. Yahoo you can't do anything with anymore. Oh, that's so sad. But how do we get it here? What you have to do is you go up here and you redo the whole URL. Notice how it says Q Bombay something or other. You go through the whole URL, and then you have to kind of download these one by one and put them back in a different sheet, and that's what I did up here. So I am putting on the website, this macro that just says if we want to get our stock, if I want to get HT media, I hope that I want to get this stock, okay, and I'm going to put it in this sheet. I'm going to put it without, you can't have the little thing. You click on this, get the URL, and here's what it does. And I put it, it's got the, right now it's going and getting every sheet. I should say that it's getting that. It's taking a little while. Okay, here's some of the things you have to do. It puts these things in temporary sheets, and then it puts everything back together. I'm proud of this one. And if I take the date, let's just take the date and kind of double click on the date. Now that goes backwards. Okay, but alas, don't worry too much about the going backwards. Let's get rid of this crap at the bottom for a minute. And then we put the closing price. Okay. Yes, closing. I'm just gonna, we can then get a graph of our price. Now they had a stock split in here, pressing F11. So how about this? I can compute the stock split. It looked like a 5-to-1 stock split. But for now, just to get finished with the video, Alt EL. That's the one thing you really should know. Let's kind of graph this and just stop at the stock split for now. That's, of course, that's a problem with Google Finances. That Yahoo did, which is very good that Yahoo did that. They put the stock splits in. You can see here they just switched it somewhere around here. Now, this thing was, remember, done in, I think, 2011 or something like that. And in 2011, the stock price was, it was around 150. And they said the stock price could never, remember, the low point was 111. The actual stock price has gone down to 50 or something. So there was something clearly wrong with that forecast, even though it had a pretty high cost of capital in there, which should have dampened the stock price. The actual was a lot less. And this is an important file. It's called Read Google from List, and that's the way we can get all our FTSE stuff, all our S&P stuff, all our stocks that don't have one of those little spreadsheets to download. You need to do this to get those stocks. So I'm sorry about the length of this video, and that's kind of video number 1 on reviewing bad corporate models.